The news keeps on getting better. Every day there are more decisions about a step-by-step easing of the restrictions. And pretty soon we'll be able to go to cafes and restaurants, pubs and clubs, which is great for those of us who greatly miss those social outlets we used to take for granted. And that also means that businesses can reopen and people can go back to work. We also have an easing of restrictions on some of the everyday real estate practices such as open houses, display villages and live auctions. Another major positive that I've personally experienced today is waking up to find the first of the JobKeeper payments from the federal government in my business bank account. And I'm hoping that at least some of you are having the same experience. The Australian Bureau of Statistics has revealed that the announcement of the JobKeeper package by the federal government has influenced 44% of Australian businesses to retain their staff. In its latest survey to map out the impacts of COVID-19, the ABS found that a greater proportion of small businesses, those who employ up to 20 people, and medium-sized businesses who employ between 20 and 200 people, were inspired by the package to retain their workers, more so than big businesses. 45% of small businesses and 45% of medium-sized businesses reported they were influenced by the JobKeeper package, compared to only 32% of large businesses. This interest in the scheme has seen 61% of businesses across the country register or intend to register for the payments, although again the rate of sign-up is much higher for smaller businesses than for large ones. Now, a sign that Australians are starting to feel a little bit better about things is the latest ANZ Roy Morgan Consumer Confidence Survey, which shows a significant uplift in the consumer confidence rating last week for the 5th week in a row. And if you're wondering why you don't know this, the reason is our news media generally doesn't deal in positives. Now, the decision by some state and territory governments to allow people to visit display homes and display villages has been welcomed, not surprisingly, by the Housing Industry Association, which represents the businesses which build the houses. We've seen a relaxation of the restrictions to date in New South Wales, Western Australia and the Northern Territory, and hopefully more will be able to follow suit shortly and get the home building industry back into full swing, assuming it can be done safely. One indicator that shows there are lots of people out there wanting to buy new homes and lots of businesses wanting to build them comes from the latest figures from the Australian Bureau of Statistics on residential building approvals. The number of approvals, or rather the number of dwellings approved across Australia, rose 1.3% in trend terms in March. And the rise was driven by approval for units in townhouses, which rose 2.8%. Daniel Rossi, Director of Construction Statistics at the ABS, says the result indicates that in March there was no evident impact from building approvals from COVID-19. However, the ABS is continuing to monitor the potential impacts in coming months. Keep in mind that the first graphic evidence of the problems caused by the pandemic was seen in mid-February, with the first big decline in the share market occurring on the 20th of February. So it's a pleasant surprise to see that a rise in building approvals occurred in March. The biggest increases occurred in New South Wales, Tasmania and Western Australia. The significance of these figures is that coming into the virus crisis, there was evidence of strong demand for new dwellings across Australia, and this will assist in the recovery phase that we are now entering. Further evidence of that comes from the data on loans to people seeking to build a new home or buy a new home from a builder. The HIA says that the number of loans to owner-occupiers for the purchase or construction of a new home rose by 3.1% in the March quarter compared to the December quarter. Even more significantly, it was 13% higher than the same time last year. Now, the HIA Chief Economist, Tim Reardon, says these results, along with other leading indicators such as new home sales and building approvals data, continue to confirm that the housing market had reached a turning point midway through 2019, providing evidence that the housing market pre-COVID-19 was heading into 2020 looking upwards. And Reardon says first home buyers have continued to be active in the market, with the number of loans increasing 3.6% in the March quarter to be 20% higher than the March 2019 quarter. Now, here's a highly notable statistics out of all of that. First home buyers accounted for 37% of the market in the March quarter, the highest proportion since November 2009. The early part of the year was a great time for first-home buyers to be looking. The federal government scheme, the assistance scheme, started on the 1st of January, meaning that they needed a deposit of only 5% to get a loan without needing to pay mortgage insurance. Interest rates were about as low as they could go, and there were considerably fewer investors in the market, therefore less competition from other types of buyers for first-home buyers. And this week, realestate.com.au reported a 40% year-on-year increase in first-home buyer inquiries on the website platform during April. Over the same period, investor inquiries fell 20%. Realestate.com.au chief economist Nerida Kanesby says, first-home buyers are well and truly in the market and are more buoyant than you might expect. Now, looking at some of the events in the various property markets, I have reported in some of these broadcasts that a number of regional cities in central Queensland have been recording a notable increase in demand from tenants and consequently an increase in rental levels. Locations that have reported this kind of uplift in their markets include Rockhampton, Mackay, and the Whitsundays region. And I believe this is because the resources sector in central Queensland is expanding and hiring new people, and that's creating the demand for tenancies in nearby regional centres. The latest to join this trend is the key industrial city of Gladstone. Rents are on the rise in Gladstone in response to a surge in demand for properties, which will see some residents paying up to $30 a week more than before. Now, the new Gladstone Open Discussion Facebook page has been somewhat bombarded with comments from people about their rent increasing. And one said, our rent has gone up by $50 a week over the last 2 years. And one property manager in Gladstone said that rents generally had increased 20% in the last 2 years. Now, this is partly because Gladstone, where the market has been in downturn because of oversupply for several years, has finally got vacancy rates down to low levels. At the bottom of the market trough in Gladstone, vacancies were above 12%, but now they're below 2%. So it's not surprising that rents are now rising. And the strength of the mining sector in central Queensland just adds further impetus to that trend. Now, I always like to include information about new infrastructure and other developments around the nation to let you all know that despite all the negativity in media about the economy tanking and jobs being lost, that there is a lot going on that's positive and uplifting, with jobs actually being created. So here's some more examples of that. Work will begin soon on Australia's biggest ever solar farm, which will be built in southwest Queensland, creating more than 400 jobs and powering 235,000 homes. Publicly owned renewable energy generator CleanCo will build the $570 million solar farm at Chinchilla, which is out west of Toowoomba. Construction will start in July, and generation is scheduled for the first quarter of 2022. So, clean renewable energy, investment of over $500 million, 400 or 500 new jobs, and work starting in a couple of months. It's the kind of news story that should be on the front page of major newspapers, but it isn't, because they'd rather tell you about how many people are losing their jobs or getting sick. Also in Queensland, a major water scheme is set to deliver many hundreds of jobs to central Queensland after being elevated to the status of most advanced dam project in the state. Queensland's Coordinator General has declared the Urana Dam a new coordinated project, and this game-changing project has the potential to create up to 1,200 full-time equivalent jobs during construction and 675 full-time jobs once operational. We'll deliver a new dam on Broken River, a capacity of up to 1.5 million megalitres, as well as a water pipeline network and an irrigated precinct for high-value agriculture. The dam project will also include a pumped hydroelectric power scheme on the upper Broken River Valley, northwest of Mackay. Now, I'm not sure how I feel about it from an environmental viewpoint, but it's a positive story from the viewpoint of the economy and jobs. In Sydney, a partnership between the big developers Dexus and Fraser's Property has achieved approval for their Central Place Sydney proposal, which allows them to move to stage 3 of the New South Wales government's unsolicited proposal process. This will be Sydney's most significant CBD project in over a decade, apparently, and it's considered critical to the state's economic recovery. The partnership's proposal is for a $2.5 billion investment that will transform the western edge of Central Station. The proposal includes up to 150,000 square metres of workspace across 2 towers and a podium building, underpinning the delivery of the Sydney Innovation and Technology Precinct. Now, also in the Sydney region, the successful first stage of the East Side Quarter at Penrith is now in its final stages of construction, and the developer, CABE, has confirmed continuation with building partner Aston Group for stage 2 of the project, which will be called Aqua, and includes 97 apartments and has reached 70% of pre-sales since launch, with construction set to begin in the second half of this year. The first 2 stages are part of a master plan development of 850 apartments, which will also feature a retail precinct, a lakefront dining plaza, communal spaces, and a whole lot more. Also in New South Wales, but way out west in the regional town of Narrabri, major things are happening in connection with one of the nation's biggest ongoing infrastructure projects, the Inland Rail development. The huge industrial estate, which is set to become Narrabri's inland port, will be even bigger than initially predicted as council seeks to take advantage of the Inland Rail project. The local council has recently finalised the purchase of 240 hectares of land for the industrial and logistics hub, and the council's general manager, Stuart Todd, says the council is considering buying even more land for the project. Doing so would make the business park the premier industrial and logistics hub development in northwest New South Wales. The $9 billion Inland Rail project, which will link Brisbane and Melbourne by train, is set to start work in the Narrabri area later this year. In Brisbane, the Queen's Wharf mega project workforce will grow from 350 now to 2,000 next year, as it newly released images show the casino, the hotel, and the apartment project rising from its 5-level basement. Developers Destination Brisbane Consortium have released new images that show detail of the sky deck, which is expected to be a major leisure draw card in Brisbane CBD once the $3.6 billion project is finished. And this project is one of many reasons why I believe Brisbane is going to be one of the nation's growth cities this year and beyond. Over in Perth, a flood of high-value development applications worth around $700 million have brought big challenges for the city of Nedlands 1 year after its new planning scheme was made law. Revenue at the council from development application fees has increased 5-fold in the past year, and the higher revenue reflects the amount of big-scale applications that have been submitted recently. The value of the work submitted in the past year has increased by $130 million compared to before the scheme change to that figure I mentioned of $700 million. In the resources industry, which is one sector of the economy that's still going strongly and was largely responsible for the record trade surplus that was announced yesterday, BHP says it has already filled 1,100 of the 1,500 extra roles it advertised across its Australia operations in response to the COVID-19 crisis. The 6-month contracts for the company's existing labour hire partners and contractors have so far included 450 new positions in Western Australia, and BHP says it's hired 45 laid-off Qantas and Virgin staff to help with social distancing and health screening at fly-in, fly-out workers at airports. Now, to the final word. If you've been listening to my broadcast, you'll know that I believe that the worst of Australia's very ordinary news outlets are the newspapers published by the Fairfax Group, which includes the Sydney Morning Herald and The Age in Melbourne. But the absolute worst of this sorry bunch is the Australian Financial Review, which used to be a serious newspaper with pretensions towards quality, but these days is as tabloid as newspapers can get. The Financial Review simply refuses to deal in positive and uplifting news, and has had a bit of a feeding frenzy during the virus crisis. In particular, this newspaper sees the housing market not as something to report, but as something to attack. Now, here's a recent article that shows the mentality that's prevalent there. This week, the ABS published the new figures for lending for real estate purchase, which shows a major increase in loans to owner-occupiers, with first home buyers particularly strong. But the Financial Review, being the miserable rag that it is, went for the only negative in sight. Its headline was, "Investors pulling out of property as lending falls 2.5%. The article focused on the fact that lending to investors had dropped, ignoring all the positives in the data. And it also focused on the only negatives in the recent core logic price data for April, which was a 0.3% decline in Melbourne and a tiny 0.1% decline in Hobart. And again, it ignored all the positives, such as the fact that prices rose to some degree in the other 6 capital cities and also in 6 of the 7 regional market jurisdictions. So what's the reality in the lending figures? It is that lending to owner-occupiers, who comprise the vast majority of the market, rose 3.1% in the March quarter. And this represented a rise of 13% on the same time last year. And in particular, lending to first home buyers had risen particularly strongly. As I mentioned earlier, first home buyers comprised 37% of the market, the highest market share by first timers in 10 years. Now that's a good news story from lots of different angles. But the Financial Review did not mention any of that. They just focused on the one negative that they could find in the figures. In a word, pathetic. But sadly, typical of what has become Australia's worst newspaper. But let's not dwell too much on that. Overwhelmingly, the news today and throughout this week has been positive, including the news from the National Cabinet that soon we will see the reopening of cafes, restaurants and pubs and other forms of retail. Personally, I can't wait. That's it for now. Let's talk again soon.